Welcome to ValueVest Daily, where we analyze the best value and momentum investment opportunities. And today we've got a special report. For months, the entire crypto world has been waiting, just watching for one thing, the big bull run of 2025. But as the year starts winding down, a lot of us are looking at the charts, just scratching our heads and asking, where is it? Well, today, we're launching an investigation to find out what really happened. Let's get into it.
Yeah, this is the big one, isn't it? The question on absolutely everyone's mind. The charts were supposed to go up and to the right, fortunes were supposed to be made, but instead the market just feels heavy, anxious, and you can practically feel the fear. So what happened to the party?
And here is the twist, the absolute plot twist of the year. The bull run wasn't a myth. It happened. It was fast, it was furious, and it sent Bitcoin screaming past an incredible all-time high of over $126,000. But now, it's over, and we've officially plunged into a pretty painful correction. So the real question isn't, where is the bull run, but what killed it?
Okay, before we dive into the evidence, you know the drill. This is all for informational purposes only and is definitely not financial advice. Please, always do your own research. So, let's start by reconstructing the crime scene, shall we? How on earth did we go from euphoric new highs to what analysts are now calling bear market territory in just a matter of weeks?
The first part of 2025 was an absolute dream. Bitcoin just soared past $126,000, and it was all fueled by big money from institutions and that seemingly unstoppable AI hype train. But on October 16th, just 10 days after the peak, the dream started to crack. A flash crash, poof, wiped out $19 billion in leveraged positions. That's borrowed money just gone in a heartbeat. And by November, well, the floor had fallen out. We were in a full-blown correction.
To really understand what happened, we have to do what any good detective does, follow the money. And in crypto, that leads us straight to our first and most important suspect, the whales. These are the huge holders who can move the entire market with a single click.
And oh boy, did they move it. On-chain data, that's just information pulled right from the public blockchain ledger, shows that since late September, whales have sold Bitcoin worth a staggering $80 billion. Let that sink in. That is a massive, massive wall of selling pressure. But was it panic, or was it something else entirely?
Now, what's really fascinating here is that this wasn't some sudden panicked run for the exits. Not at all. This was a calculated move. The original pre-2013 OG whales, they started taking profits in early October, before the top was even in. The selling just picked up steam after the all-time high. And even with a little bit of buying in November, the trend was crystal clear. The big players were systematically cashing out.
So, the motive wasn't fear, it was pure strategy. Think about it. After a 200% rally, it was just time to lock in those massive gains. These experienced players saw all the signs of a late-stage cycle, and they started selling into all that retail excitement and FOMO. You add in some growing concerns about what the Federal Reserve is going to do next, and you have the perfect recipe for a strategic, calculated sell-off.
But the whales weren't the only ones selling. Our second suspect is the big institutions. Yup, the very same players who went from being the heroes of the bull run to, well, not so much.
In just 3 weeks, a massive $2.66 billion flowed out of the spot Bitcoin ETFs. Now remember, these are the funds that made it super easy for traditional investors to buy Bitcoin, and they were the primary engine of this whole bull run. So seeing money leave them this quickly, that signaled a huge shift in sentiment from the big money players.
And this quote from a market analyst just says it all. While some of that early selling came from longtime holders, it was the U.S. institutions that really pushed Bitcoin below that critical, that psychological $100,000 level. The market's biggest buyers had suddenly become its biggest sellers.
But here's where it gets interesting. It wasn't a simple story. It was more like a giant market tug-of-war. On one side of the rope, you had the major ETFs from BlackRock and Grayscale that had to sell as their clients pulled money out. You had hedge funds trimming their risky assets, but on the other side, you had these deeply committed bulls like MicroStrategy, who saw the dip not as a crisis, but as just another buying opportunity for their corporate treasury.
So no market crash happens in a vacuum, right? The whales and institutions may have been the primary suspects, but they had accomplices, a whole series of powerful macroeconomic forces applying pressure from all sides.
And honestly, this might be the most important part of the whole story. This wasn't just about crypto. You had the Federal Reserve taking a more aggressive or hawkish stance on inflation, which made safer investments like bonds look way more attractive. At the same time, that AI narrative that fueled so much of the year's rally, it started showing cracks with some disappointing earnings reports. It all came together to create this perfect storm, where exhausted retail investors and over-leveraged traders just ran out of steam, removing that crucial support from the market.
Okay, so we've dissected the past. We've looked at the evidence. But what about the future? With the bull run officially in the rearview mirror, what are the analysts predicting for the road ahead?
Well, what's fascinating is that despite this pretty brutal downturn, many of the big names are still incredibly bullish for the end of the year. Standard Chartered, they're sticking with the $200,000 target. MicroStrategy's Michael Saylor still sees $150,000. Even JP Morgan is targeting around $170K once the current deleveraging is over. You can see Bitwise revised its forecast down a little bit, but even their new prediction is for a new all-time high.
So to simplify all those numbers, this chart gives us a much clearer picture. You've got your bearish case, which sees Bitcoin kind of hanging out in the $80,000 to $100,000 range for a while. But the strong consensus among most analysts falls somewhere between $130,000 and $200,000. And of course, you always have the super bulls, the outliers calling for $250,000 or maybe even higher.
So, we've examined the evidence, we've heard from the experts, and we've looked at the data. What is the final takeaway from this whole investigation? Well, it all seems to boil down to a classic, timeless market conflict: fear versus opportunity.
This number pretty much says it all. Right now, the crypto fear and greed index is sitting at a 16. That signifies extreme fear. The market is terrified. Panic is in the air. This, my friends, is the point of maximum pessimism. And that brings us to our final, provocative question. Our sources clearly note that moments of extreme fear, just like this one, have time and time again marked major market bottoms. So, is this number a final warning sign to get out before things get even worse? Or, as some of the world's most famous investors believe, is this the exact moment that presents the greatest window of opportunity? The answer to that question is going to define the next chapter in this market's incredible story. Please subscribe, like, and share ValueVest Daily for learning daily opportunities before you put your money to work. And hey, one more thing. Please put in the comments if you want us to deep dive any specific ticker symbol. Thanks for watching.